Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course module number 5. It's about fresh money in the order flow. And one of the important things as an order flow trader is to recognize when fresh money comes into the market. And one of the hardest parts of analyzing order flow is determining if the current order flow is new money that is flowing into the market, meaning new positions being put on, or if the order flow is money leaving the market, positions being exited. Now, as a screen-based trader, there's no way to know if the order flow is new money flowing in or just an existing position being closed. However, understanding the type of trading that's occurring, be it on the bid or on the offer and in relation to the market context, a trader can begin to get a feel if the trading is new money coming into the market. So the easiest way to determine if new money is coming into the market is to understand where it should be coming in. For me, the easiest way to decide if new money is coming into the market is to watch the footprint. Now, specifically, the delta footprint, which is the delta at price. Generally, new money is going to be lifting the offers or hitting all the bids. I also look for the market to turn delta bid at new highs or turn delta offer at new lows. So, what do I mean by the delta footprint? So this is the delta footprint. It looks a little bit different than your normal footprint chart, and the main difference is it's just telling you what the delta is at that particular price level on the horizontal, not the vertical. Not the two-way auction. Specifically at a price. So if you see a positive delta at a price with nothing next to it, that means that there was aggressive buying at that price level. If you see like a negative number with no price to the right of it, it's telling you at that price level, that's what the delta was between the buyers and the sellers at that particular price level. And when you're looking for new money, like I said earlier, fresh money, new money, I kind of use those terms a little interchangeably, and I use them interchangeably because for my mind, they mean the same thing. So, when you're going out and taking out the highs, right, you want to be seeing, obviously, the highs are going to be taken out on aggressive buying. It's going to be lifting all the offers. But earlier, right, I said, I also look for the market to turn delta bid at new high levels or at new low levels, turn delta offer. And you can see it right here. You hit this new high level right here, it turns delta bid, negative 361. So somebody is bidding at this price level, in addition, 361 contracts more than what was being offered. And that actually traded, right? It's not the level 2, it's not the dome. It's telling me that at this price level, this could have been 861 contracts traded on the bid here versus 500 traded on the offer, but it was enough to turn the market bid. And what does it mean when you turn the market bid? So the market, there's bid offer, right? It's 5 bid at 6, and you want to buy all the 6s, and you still want to buy more. So you bid, maybe there's 50 lots offered at 6. You put an order in, buy 100 at 6. And so you lift all the 50 contracts that were on the offer at 6 and you turn it bid. Now it's 6 bid for the remainder of your balance. That's what I mean where it turns the market bid. Here's another example. Obviously you're taking out all the offers on the upside. Then the market turns bid here, 134, 112. It's another 266 here. It's not just turning a bid on 10 contracts, 12 contracts. It should be a solid number. In this case, 100 is definitely solid. 200, even more solid. Earlier, the previous example was 361. That is strong buying. That's new money coming into the market. Market's going up here. You can see it's turning bid 99 here, 71 here. This is crude oil, so the numbers are different than, say, on E-minis, right? You can't say, well, it's got to be at least 100 contracts on this particular market, and it doesn't really trade that big size. If it was something like euro currency, to expect, market to turn bid for, balance of 100 or more is probably not going to happen. But on E-minis, it happens pretty regularly. On crude, the borderline is, 50 to 100, but you see, turns it, here's 99, here's 71. Up here is 119, so they're turning the market bid. They're lifting the offers, bidding over on a market that's selling off. This is crude oil. You see all the bids obviously getting hit as the market's going down, but I'm looking for where it's turning offered. Here's 87, here's 49, here's 42. Up here at the beginning of this move when there's still more to that move coming down. Okay, now notice, right, we come into this low. I said my note here was not strong selling into the low, looks mixed, meaning the market may bounce off the low. So it's coming down. There's some strong offers here. 156, 184, 124. All the bids getting hit. All the bids basically getting hit. All the bids getting hit. When you get down in here, there's some very strong bids here. It's 233, 156, 250. Market just can't get past there. Now remember what I talked about when I was talking about vertical versus horizontal market activity. What stops a vertical move is liquidity, resting liquidity. The market is running down here into resting liquidity, and then you start seeing the opposite happening. Market starts getting lifted, right? All the offers basically getting lifted here. Turns bid 197 here. Market's next bar, mostly all the bids getting lifted here. And when you see it turning bid here, it's 169, it's 146. The next bar comes in, comes off a little bit, but you see more supportive buying coming in here. 275, 83, 142. 106. So while there was strong selling on the way down, when it hit that low, the market reversed and started going back up. Now, I don't want to get ahead of myself, but you got to ask yourself where fresh money, new money is going to come into the market. But before you do that, you got to understand what really is new money. Well, new money is traders putting on new positions, obviously, right? They're committing themselves to the market. Now, again, when I talk about new money, I'm talking about institutional new money. I'm not talking about, the retail trader that's trading 5, 10 lots. I don't care about that volume. Really what you're looking for is the big traders, what they're doing, because those are the people that you want to copy and jump behind when they're trading. Now, the new money, they've been sitting on sidelines waiting for something interesting to happen in the market before they get involved. Okay, so if you're at a low, that's an interesting area for them to get involved in. You're at a high, that's an interesting area for them to get involved in. Market can keep going higher or it can reverse and sell off. Just as if you're going down, making new lows, the market can reverse, go up, or it can go down, make fresh lows. It's not going to be in the middle of value area, right? They're not going to get involved in the middle of the value area, the middle of the day's range. They're not going to get involved at the unchanged level, right? So you got to know where new money should be attracted in the market. All right, it's a perfect example. We hit the high, started selling off. Okay, some strong selling here in this bar right after the high. Then you sort of went sideways, a little bit more selling, strong selling here, but it attracted people that were sitting on the sidelines. This is my opportunity to buy, to get involved. What happens here? They lift all the offers here in this next bar, right? Except these two down here on the bottom. Comes up, pulls back a little bit, pulls back right to the point of control. Again, mostly lifting the offers in these next bars as you start making new highs. As you start making new highs, you see they're turning the market bid 70, 96, 100. So what are the signs that new money buyers have been attracted to the market? Well, contract highs, lifetime highs. Now, people say, well, who wants to buy a contract high, lifetime high? Trust me, markets make new highs all the time, okay? And often, the high from a certain day gets left in the rearview mirror as the market keeps making higher highs and higher highs. It's most traders tend to just be focused on the main contracts, right? E-minis, crude oil, bonds, euro currencies, but there's so many other contracts out there. There's a good solid 40 to 50 contracts just in the US alone that are available for traders to trade. And at any given moment, one of those contracts could be making a new contract high or a new contract low. Don't think that the world just revolves around the E-minis or the mini NASDAQ or the Dow or the euro currency. There's so many other contracts available for traders to trade. Other areas could be the overnight high or the daily high. Initiative buying, which I'll be talking about in module 7. Buying above value, that's where new money buyers, right? I'm talking about buyers could be attracted to the market. I should put in there the lows as well, right? The daily lows can attract buyers as well, new money buying. And you must look for the new money in the market, right? Don't assume that if we hit these levels that new money automatically appears. Not always. We can hit a contract high and the market just drifts sideways. No new money coming into the market, right? That's what happens when the markets sort of go into consolidation. There's no money in there. I mean, in the sense that that's going to drive the market in a direction higher or lower. Now, for sellers, new money sellers, it's sort of the opposite, right? It's going to be contract highs, lifetime lows. They keep the trend going, right? Overnight low, new daily lows. Again, also the highs. I should have put that in there in both of them. I'll add it there because I don't want you to think that it's just restricted to one or the other, right? Because sellers come in at the highs, new money sellers come in at the highs, people waiting for the market to hit a level, and just as buyers wait for the market to sell off enough before they start buying. But again, where value is, right? If it's going to be initiative selling, right? Got that slide mixed up. The initiative selling is going to be selling below value. But again, I'll be talking about initiative activity in module 7. And again, you got to look for the signs of new money coming into the market. But what I'm going to show you in this module is how to recognize the new money. Now, another area where you're going to see new money coming into the market is when it's testing supply and demand, right? What do I mean by testing? I mean the market testing supply and demand. But when you're talking about supply and demand, usually where is supply and demand? It's at the highs or at the lows. So you got to be asking yourself, is demand coming in? Is supply coming in? How can you tell? You look at the delta. That's why I always spend a lot of time talking about delta. And when you're looking at a delta footprint chart, it's sort of, for a lot of people, they say, well, I see the footprint, the volume footprint, and it really opens my eyes to everything. Then they look at the delta footprint and it's like, their mind gets blown because now they're able to see the inside of the market, because they're able to see where the new money is coming in. You can see here it's just getting all lifted. You're testing the new high, clearing it, blowing it away. I just want to talk about, you leave the high in the rear view mirror, right? And you just keep going higher, 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 higher. Right, this is another example, right? This is where you have to be careful though. Resting liquidity, again, stops vertical moves, right? But sometimes you get past it, right? You can see we hit this high, 200 contracts trade, 221. You get past it, you squirt up, but it's exhausted already, right? The new money is just enough to get it through, and then it comes off. It has to rest a bit to get them interested in it some more. Because often if it's new money coming in, hey, I'm buying it here, I'm buying a boatload here at 1786. Market starts its move up to 1788, starts coming off. Then the broker calls up, hey, you want to buy any more? And where are we trading at? Well, it's trading 1785. Sure, let's get in, buy me another 200 contracts. Market starts working its way back up. You see it gets past 100 here at 1785. But be careful, okay? Because you want to see follow through, right? If you get that initial move but no follow through, it's either going to go sideways or come off a little bit more and perhaps stop you out. Follow through is important. Here you are testing a high with high volume, right? Here, boom, look at this. You're just chugging along, volumes average 200, 400, 400, 1400, okay. Then boom, 2000, 1800, 2400, 1400, 2700. Very strong buying coming into the market in terms of volume, right? It's mostly trading on the offer side. It gets up some decent bids in here. Or you can even see the market is rallying up on some negative delta, in the sense that there was some strong supportive buying here. Look at this, minus 184. They turned the market bid, right, as you get up higher. All right, here you can see this bar. It's a green bar, but what happened is market traded higher, poked up here, and then sellers started coming in, but buyers are stepping up. The new money coming into the market to support the market right in here. They're selling. All these sellers are selling into these bidders right here, right? You end up with negative delta. Market turns around, goes a little bit higher, right? Higher some more. Still the bidding in here in the next bar. You can see as the market keeps running up. You see over here, new high level, 111 contracts right here on the bid side. Now, here we are at the low, right? Again, At a low, you could attract new buying because, people think, yeah, the market's sold off enough, I can start buying. All right, like if you watch the movie Trading Places, at the end when they're trading orange juice, right? They're waiting for the market to sell off, before they start covering their shorts. What's happening here? Market's selling off, selling off, selling off. Boom. Okay, yeah. Flip the switch. Let's start buying. Computer says to start buying. Start lifting all the offers. Look at this. They turn it bid. 308 contracts right in here. Support the market. Boom. They get filled. Market comes off a little bit. Market starts again lifting more offers in here. All the offers. Right. A small bid in here of 38, net 38 in the delta. Okay, so when new money comes in at lows, you often think of buying opportunities, bargain hunting. But then it might be new sellers, right? It's an obvious place for fresh money, new money coming in. So what do you got going on here, right? Market's selling off, right? Oh, look at that. Hitting all the bids, right? But market's going up, but it's people offering out down here. 48, 81, 125, 228, hitting the bids. Every time it starts coming back up, there's some strong offers. 438, 348, 102, 255. So, even though the market is trying to go back up, there's still people offering it out here enough to drive it down. Yeah, the trades here 348, then they just hit all the bids. Right? Market starts coming back up, trades 102 over here. Then they basically hit all the bids, 81, 35, 362, right? And market continues on down. So, at a high, when supply comes in, that's not new money, right? Supply was purchased earlier. What you see is profit taking. So does that mean that all selling at highs is not new money? No. New money can come into the market in the form of fresh money, right? It's not supply in the market in the supply and demand sense, right? When you think of supply and demand, sort of, left and right hand, what you're seeing is two different types of selling, right? You can see profit taking, right? If you got long earlier, you're at a high, that's not people distributing, that's not new money because you're already in a position, right? New money is money that's been sitting on the sidelines thinking we're at a high level, I'm going to start selling. So it's slightly different in the paradigm of supply and demand. So there's two different types of highs you got to think about. One is a supply high, which, is when people come in and have bought earlier and they're starting to sell, right? They're long and okay, it's a great level. I can start getting out. And there's what I call a retreating high, which is kind of like, think of it as resistance. Okay. I call it retreating high, but it's more of a resistance high. A supply high is formed as the market is rallying and running into strong offers, right? Why? Is because this is often profit taking from lower levels. Right? You see buying imbalances and strong delta, but the market does not go any higher. So it's the signs of a supply high. This strong offer volume traded on the way up to the high. POCs appearing near the top of red candles. Buying imbalances, but the market's not really going higher. Strong positive delta, but the market's not really going higher. Versus a retreating high is slightly different. It's still a high, but sort of the way it's made up is different. It will often come in after a high is made as sellers are attracted to the market. This is fresh money coming into the market to take advantage of the market getting ready to sell off. The signs of a retreating high is new highs and sideways activity, delta weakening, selling imbalances appearing, right? You're at your high, you got weak delta and selling imbalances appearing. Well, that's not a good sign, right? That's a sign of a market getting ready to sell off, and you're usually going to see a big down red candle. So let's take a look. Here we got supply present, right? It's lifting all these offers, but the market's not going any higher. Even here, right? You've got a new, it's the same high, not a new high. You got positive delta the bar before, positive bar the bar after. Market's not going anywhere. It's not going any higher, right? That's not a good sign. Instead, what you're seeing, people are offering out their supply up here. They're happy to offer it out because they probably bought earlier. They're working, these are their take profits, right? People that trading in an ATM, think of an ATM, the automatic trade manager. You got long at 16. You got to stop up, take profit up here at 22. That's what you're seeing up there, basically. All right, then you're seeing eventually the market starts selling off a little bit. Again, similar thing. You're seeing supply present, This is profit taking from lower levels, right? You're seeing strong offer up here, strong offer here, and this is a level, right? We went up, came off, going back up, right? Where was this volume here earlier, right? It wasn't there earlier. But now people are like, well, this is my chance to get out. You know, the market looks weak up here. They're looking to get out, all right? The market sells off a little bit after we hit that second high. Now, here we are, right? If you're using the order flow trader software, right, you're familiar with prominent points of control, which indicate supply. You know, it's a resistance level in the sense that, you know, markets, you're looking for the market to come up here and reverse. Here we are, market going up, and you see some strong offers here: 2,200, 700, 1,700, 3,500, 4,400, 1,700, 3,000. Right? So, you know, as this market is going higher, you know, people are realizing, hey, you know, I should start working some offers, work my way out of my longs from earlier, right? As we start to come off here, you know, people start hitting the bids, right? Resistance selling coming into the market. Now, support is, you know, when you see the market make a low, right, you're going to be looking for a support. Okay, and what you like to see is after you see support, you want to see people start lifting the offers, because it's one thing to have support in the market, but then you're going to want to see aggressive buying coming in. And again, looking at a delta footprint chart is a lot easier to see sometimes than on a volume footprint chart. So as the market makes this new low here, you can see the volume. Look at that delta here, minus 3,600. So you know there was a very strong bid in the market here. Market turn around, lift the offer, lift the offer, lift the offer. Next bar, offer, 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 offer. Yeah, market comes down again a little bit, and then you get offer, 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 offer. Here you have strong bid, strong bid. Okay, so you're starting to string, you know, 4 out of 5 bars are extremely bullish in terms of the order flow delta and the footprint. Okay, so you got to learn to look for things like that in the market. You know, if I can convince one person to start using the delta footprint chart, and you know, that's all they use and become successful, then I'm happy. You know, but it's something that you have to make the adjustment to. Just because I say, you know, take a look at the delta footprint chart, you know, then don't spend any more time with it. Spend a few days with it. Spend a week or two. You know, on the weekend, look at all the charts you looked at for the past week on a delta footprint, and you're going to be able to see these areas where the new money is coming into the market. Okay, so here we hit our high, right? We got some resistant volume, right? This is the market resting liquidity, stopping the vertical move. And then what happens? We hit that high. Basically, over the bar with the high and the next bar, it's basically just all the bids getting hit. Boom, 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 boom. Then the market sells off. Right? This was the area. This is the 2 bars telling you to get short. I'm not saying you'd get short up here, you know, right at the high. No, in here, this area where it's going sideways, you know that there's strong selling coming in. That, you know, honestly, if this market sort of rotated back up to around this 25 area in here, you'd probably still see this selling coming in to move it down. But you just sort of going here sideways horizontally, that's your opportunity to get short, you know, 15 area. You're not going to get short at 25. That would be a gift. But, you know, if the market rotated back up, you'd probably see the same selling coming in. You know, but you're getting short at 15, you know, move down to the figure down here. Okay, here's a 4 range chart, a little slower chart. But again, you know, you hit the high, and then the aggressive selling just comes in here. You know, here you had some aggressive selling, some buying came back in, but then just met more aggressive selling. And then a bar later, more aggressive selling. All right, so you got 1, 2, 3 very, you know, in this bars also, half-half, same with this half-half. So out of these, what was that, 6 bars, you got 3 definitely bearish bars. New money just all hitting the bids, all hitting the bids, all hitting the bids. Here, you know, this bar is mixed, this bar is mixed. This bar, it can go either way. You can say, well, that's bullish because, you know, you got some supportive buying in there. Okay, fair enough. So out of 6, 3 extremely bearish bars, all hitting the bids. two bars that are kind of mixed here. This is a doji bar, and this is a this one's just mixed both sides, and this one, call it bullish. So 3 bearish, 1 bullish, 2 nothing, right? So what do you think the market's going to do? It's more inclined to sell off and get a move from 50 down to about 42, 41 down in here. We went lower, but that was your sign in there. Now there's different types of lows. I sort of talked about lows. I threw in a slide about the lows just now, but there's different types of lows as well, right? Support lows and demand lows, right? Which sort of run opposite to the types of highs I just explained. So a support low is made with resting bids soaking up all the selling coming in, right? You start seeing it prior to the low being made. What to look for in a support low is lows being made with heavier than normal volumes traded on the bids. Points of controls near the bottom of the green up bars. Small delta, positive or negative, which is a sign of aggressive selling into the resting bids. Demand low occurs when the market has been selling off and now new money is coming into the market to lift the market off the lows. It's often seen with lack of selling. So what to look for in a demand low is lows being made, volumes on the offer being lifted stronger than volumes being sold into the bid consistently, volume distributed throughout each bar, buying imbalances. Okay, so let's take a look. Right, here's the demand low, right? You got your nice prominent point of control. Market starts working its way back up. Now this is a volume footprint chart, and like I said, it might be a little bit hard for you to see it on there. That's why I say go to a delta footprint, right? That's the same bar here. This one is this one right here. So you can see it's running into support, then all the offers getting lifted. Most of the offers getting lifted here, just about all the offers getting lifted there, right? It's coming in right off the low. Again, same thing as a footprint chart. Might be hard for you to notice, right? This is why I say shift your chart to a footprint chart, a delta footprint chart rather. So you can see here, right up off this low here, you can see the offers getting lifted. Even here, you can see the offers getting lifted, right? All here, all here. Yeah, market came off, sold off a little bit, made a new low by 2 ticks. Then the new money's coming in here, right? You started to see it earlier here, but there's still just a little bit of selling left, and then it hits that new low. But again, you're seeing the same thing here, here, here that you saw here, here, here. This one actually looks a little bit better because you have that volume in here, but whatever. This is supportive volume, which is also bullish. So you got a little bit of a move, come back down. Okay, let's try it again, and then you get the move you're looking for. Again, support low, resting bids are absorbing the buying. And again, for some of you, it might be a little bit hard noticing it on a normal volume footprint chart. That's why I suggest going to a delta footprint chart. Here you got all the mid side being sold into here, 224, 808, this whole bar, right? Then you start seeing more lifting, supportive buying, right? So I talk about supportive low, right? As the market's going higher, you have supportive, support. All the prices at the low and below in each bar that's traded there, it's all supportive buying, right? You don't see people more selling in here, offering it out. All support here, 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 right? All the majority of the prices above, it's all being lifted here, here, here. This one is a strong buyer right here. You'll notice that's where the market came right back to a few bars later, right in here, where you had the big buyer. The big buyer is still here. Here's your support low, right? Again, if you're looking at a volume footprint, it might be hard for you to see. But when you look at the delta footprint, look at what stands out, right? You might have missed this 483, this 258, this 493, right? There's a big seller in here trying to put a cap on the market, but they can't. They sell about 1,000 extra contracts versus what the buyers were there. 454, 258, maybe it's about 1,500 contracts when you take into account what was the other volume going through there. It's 454, that's 900, 1,150 just in the delta at that price alone. But when you get down in here, someone just happily buying all these things passively. Yeah, sure, I'll take what you want. Then it's important to watch when you get back up in here, if you clear that, once you clear that, you had the strong seller in here. Once that seller gets cleared on the way back up, it's off to the races. So, keep an eye on that. We have an indicator called the bulge, which sort of looks for these things, these delta bulges, because oftentimes you see the bulge, you sell off, but when you come back up to that level and you get past where the seller was, if that seller is no longer there in the market, it's off to the races, right, in the other direction. Because what was sort of forcing the market down earlier, that force is removed from the market. So what direction you think the market's going to go? It's going to go back in the opposite direction. So testing a low with high volume is bullish, as it indicates demand, buyers are present. And trying to recognize the end of a rally or sell-off can be a difficult proposition for most traders, because most traders try to always be exact in that they are looking for that one price for the market to reverse at. On trend days, trying to find the end of a trend, you can find yourself looking at many losing trades, right? Don't try to predict an end of a trend. Let the market tell you that the end is near, so to speak. However, there are clues in the order flow when coupled with common sense that can help you determine that the end is near, right? The end of the trend. So remember, markets can and do move on light volume, but when you start seeing heavy volume coming in during a market rally, keep an eye on the order flow for potential top forming. Ask yourself, is the market still making new highs or going sideways? Resistance coming in, and are sellers being attracted at these new high levels, right? The bid volume and the offer volume, as well as the delta, will help you determine the type of high that's forming. So where it gets tricky is when you see aggressive selling on moves up and aggressive buying on moves down. Now, this is often early institutional activity, but when you see institutional selling as the market trades the highs, often a cap is being put on the market, just as when you see institutional buying coming into the markets as the market making lows, a base is being put in. So this is going to come in before the high is made or before the low is made. So let's take a look. Aggressive selling going into the highs, the 836, the 174. Then we just sort of go sideways, come off a little bit. More aggressive selling, the 1109, the 722. 735 finally takes over and comes off. Aggressive buying on the move down. Obviously, this is what I just showed you earlier with the big volume. But you had a big seller here, right? It's sort of telling you this move probably can be over if the market starts reversing and trades back up into it. Okay, so honestly, I wouldn't be looking to buy down here, especially after the big seller. I'd be more keen on, if we get back up to that level and get past it. Okay, here we got aggressive buying on the move down, right? People are trying to pick the bottom here. The 93, the 16, the 57, before finally people realize, yeah, the bottom is probably put in, and you start going sideways, and then the market takes off on the way back up. So, when a market is making new lows and someone's got a lot to buy as the market is going down, it's very easy to buy, right? As the market is making new highs and you got a lot to sell, it's very easy to sell. So that's why you often see, that's where the institutions are going to be selling their positions out, because it's not going to move the markets. So remember, weakening moves, as traders commit themselves to a move, the amount of traders who can keep committing to a move gets smaller, right? The market then will proceed to form a top and reverse, not because smart money sellers appear, but instead because there's no one left to buy to sustain the move up. The only thing that's going to help the market is continued buying, and the continued buying is not there, then what's going to move the market higher? Nothing. The opposite would be true on a move down. If the sellers are no longer there, just as the sellers that were here, if they're no longer there, who's going to move the market lower? They're done selling, right? The market is going to automatically snap back, right? Because there's no more interest in sellers, right? Who's selling? Nobody, right? That's why the market's going to go back up. So, I'll just give you something to think about, on a commercial side, because I spent many years on the commercial side as a trader with Cargill. And, how commercials think, it depends on the commodity. A gold miner may sell into a rally not because he thinks the market's going to sell off, but because he has inventory to sell, right? He could be selling some of his future production to lock in profits, but he's not necessarily getting short. Okay, this is how commercials, right? Because, everyone lumps in commercials and institutions, like the banks, in the same group when they're really not. A producer, right? Someone that makes chocolate bars. will buy into a downward move, whether it's cocoa or sugar, because it lowers his input costs. He's not going to lower the price of the chocolate bar, but his variable cost is going to be lower. He's going to have more profits, so he's going to be happy. So he's going to buy on the move down. He's going to be working bids on the move down, not necessarily to support the market. It's more in his favor if the market keeps selling off, because that's his variable cost, right? So he can get his ingredients cheaper. So, try and get your head around that. Again, it's not something that people really talk about, because, you don't really hear a lot of commercial traders that, go on to start hedge funds, but there are some. And, their thinking is a bit different than, former bank traders that start hedge funds. So anyway, that concludes Module 5. In Module 6, I'm going to discuss order flow rotation. So I'll see you on the next module, everyone. Bye-bye.